Okay, folks, everything you seek in price action is found in this formation: the open, the high, the low, and the close. The ICT concepts used in this module will be the importance of time and price. We're going to be revisiting the power of three, and we're going to be specifically teaching monthly time and price characteristics, weekly time and price characteristics, and finally, daily time and price characteristics. Okay, ICT power 3 and the monthly open. Now, price action is fractal in nature. That means everything that you can see in terms of a price pattern on a 1-minute chart, on a 5-minute chart, can be seen on a monthly chart or weekly, any time frame, any interval of time measurement that plots price. The fact that we can see a pattern on any specific time frame, price action has a generic characteristic to it. So whatever we see in one time frame could be easily replicated and seen on a lower time frame or a higher time frame. So when we see price patterns, it's not that one time frame is better than the other per se, but there is an emphasis or significance that's placed on the higher time frame charts over the lesser time frames. For instance, the monthly has the most significance to me in my analysis, and because it gives me the ability to look at a whole year or multi-years, or I can look at it from a quarterly basis or a biannual basis, in other words, in 6-month intervals. So I don't need to see any other time frame because the monthly gives me all the depth and detail that I would ever need from a macro standpoint. Which brings me to the purpose of using a monthly chart is that it provides a macro institutional bias. So we can see what large institutions are doing or what their sentiment is based on what these higher time frame monthly charts are revealing in price action. In a nutshell, if we are doing our analysis on the monthly chart and we deem that monthly chart to be bullish, we as traders and analysts, we look for buying opportunities at the opening price or below the opening price. If we have come to the conclusion that the monthly chart or perspective on the monthly is bearish, then we are focusing our analysis on selling short at or above the monthly opening price. Now, large institutions use algorithmic systems that key off of monthly and weekly opening prices. Since there are massive amounts of volume in these entities' actions, we would do well to imitate or mimic their actions and directional bias. So let's take a closer look at this monthly chart. This is the euro dollar. And if you've gone through my material, there's a lot of things that I teach by way of directional bias, picking a direction, sticking with a specific direction, looking for key levels, looking for key targets, looking at this sample size of price action on a monthly basis for the euro dollar. I want you to take a look at what you're seeing in price action. Now, obviously, majority of what's already happened is all hindsight, but it's for your learning. For the individuals that have gone through my mentorship in 2016, 2017, they know that I was bullish in the first quarter of 2017 with the euro dollar. And I called a specific price point of 120 at that time. Several months later, here we are in December of 2017, you can see we did in fact hit that 120 mile marker on the euro dollar. It was based on what I'm about to show you here. A lot of other things that go along with it to help fine tune that detail, but generally it started with this concept. Do you see anything that stands out in the chart? For instance, this old low over here. It's a relatively equal price, makes an attempt to drop lower, and it does in fact go below these equal lows, and then it does what? It trades back above those lows. And then we have a swing low form. We have a candle to the left with a higher low, a candle in the center, and a candle to the right. So there's our 3-bar pattern or swing low. And then we wait for that third candle to be penetrated. We have it here. So that way, now we can start looking for being bullish on the monthly chart for the euro dollar. We see the previous month, even though it had a weaker close, it still was an up close. And because we broke the swing pattern for a swing low to be valid, every subsequent candle should be viewed as bullish until we get to some key resistance. This is a key high. It's caused a market turn, so we're going to have to keep our focus on here. And just like we saw market movement go below this low here, true support resistance isn't line in the sand. It can't go any higher than that. We understand that there's going to be a willingness to want to go through that high to seek some measure of liquidity, just like it looked for liquidity below these lows. So with those ideas in mind, let's add some lipstick to this chart. So now we have a long-term key low, and we have a long-term reversal in the form of a false break below, swing low forms, and then I started delineating all the opening prices on the subsequent months. So every one of these candles represents one full month's data. And then I noted the long-term key high here. So we will be looking for down here a move above this high, which if you think about it, that is a lot of pips. So I know I've been doing a lot of work on Twitter and on my YouTube channel to be active with day trading and scalping, just to show my proficiency in studying and reading price action and executing on those lower time frames. I have tools and applications that work on higher time frame charts like this. If you can't do day trading, I have methods that help you do these types of things. I personally do not like this style of trading. It's too slow. It doesn't give me enough action. And I just excel as a short-term intraday trader and day trader and short-term trader for one shot, one kill. There are many students of mine that can't do that because of their businesses that they're running or their jobs, or they're just unable to do it because of their family commitments. They just can't do it. So they need a larger or higher time frame perspective. And this is one way you can do that. So we have a monthly chart here with the opening prices after a swing low and a violation of an old low. And once we start to trade back above that low here, we start looking for validation with this swing low being in fact valid. And we have that on this month here. So we had plenty of time, several months before this month begins the hunt for longs. So It gives you lots of time to get prepared. You don't have to be in front of your charts every 5 seconds. In fact, you don't have to probably watch it every day. You just got to be aware that this swing low has to be validated, and it does it here when it starts to trade above this candle's high. So with this information, let's take a closer look. And now we have the daily chart of the euro dollar. And what I have here is every specific monthly opening price delineated with a small little horizontal trend line segment. So each little short trend line that's moving horizontally, starting with this one here, this represents a monthly open. What's the opening price of the month? And this is another one, this is another one, this is another one, another one, and finally the one up here is the last one I'm going to reference in this specific teaching. So we're going to start with April 2017, and we have seen a potential long-term reversal, and we're going to be looking for buying opportunities, and we're going to look for validation to see that in price action. Now, if we're bullish, we want to see signatures in price action that support that idea. That means the opening price, and below it, we want to see some bullishness or buying. So is there a swing low that forms below the opening price on the monthly? And is it showing energetic price action once that low forms, and does it move higher with magnitude, strength, and speed? Well, we have that here. Not too long after that, we start seeing price move higher. Obviously, I'm using this chart with the benefit of hindsight for its time purposes to save a lot of time in the recording. But you can see that reference point there below the opening price of April gives us a nice buying opportunity. You can look at many instances of overlapping for optimal trade entry at that price point. And we're moving to the next month. This is May 2017. Again, we're looking at that opening price of May 2017. And we want to see a willingness to go below the opening price and then find buying. We have that here. And again, very, very strong reaction in price action. And the market starts to move rather aggressively on the upside. Moving right along, we're going into the next month. This is June 2017. And again, we have the opening price of June. And below the opening price, we want to see buying. We see that, in fact, does come to fruition here. Very nice accelerated movement on the upside. And again, now we have July of 2017, the opening price delineated. And we want to see a movement below the opening price and then buying. Nice optimal trade entry, long pattern there as well. Very, very explosive price action up to that horizontal maroon color line. That is that old long-term high. So now we hit that in the month of July. At that price point, now we have to start easing off of our expectations of being bullish. Doesn't mean completely abandon the idea. It just means that we have to slow down and not be so aggressive. But we can be aggressive in looking for that long-term high to be traded to every previous month. But now in July, we can see price did in fact hit that level. So we have to be mindful that it could stop. Now the next month here is August of 2017. Similar pattern. We have movement below the opening price of August. And again, a nice little rally up. And it moves, it moves about 400 plus points or pips above the old long-term high. So obviously we can't use a 10 to 20 to 30 pip sweep idea like we do with intraday charts, looking for movements beyond the old highs and old lows or double bottoms and double tops. When we're using longer term time frame levels, we have to have a greater expectation in terms of the magnitude or range of how far it'll move past those price points. Now, I don't have a science to that. I do use Fibonacci to help me get to those levels. It's not always accurate. Sometimes it falls short of it. Sometimes it goes beyond what I thought was going to happen. And that's technical analysis and trading. You're never going to be perfect. You're never going to be right. But over time, you're going to see that this method serves you very, very well. Now, we can take these ideas also and transpose them to the weekly opening price. Now, this is going to be the framework for a lot of the things that I teach in my mentorship for my one shot, one kill, which is essentially trading the weekly range. Now, I'm not going to be teaching that here, but I will give you some of the signature points that will help you with the free tutorials to get really close to how I do one shot, one kill. But if you want to learn it, you can go through the mentorship and get all the fine details about how to do it and how I look for it, get the weekly high and the weekly lows. Well, if we go through this specific idea with weekly opening price, again, price action is fractal. And what we would see on a monthly basis, we would expect to see that same thing on a weekly basis. So the weekly charts provide an intermediate institutional bias. That means it's not a long-term bias, but it's not short-term either. So it's a pretty good time frame to look for like swing trades or even a little bit longer-term, short-term trades, not just 1 or 2 day trades in duration. Longer-term, like 2 weeks to a month, this is the perspective you want to be looking for to get those types of setups. But what we use for the weekly open, if we know that our analysis leads us to a bullish weekly perspective, we're going to be focusing on buying at or below the weekly opening price when bullish. And when we're bearish on the weekly, we're going to be focusing on selling short at or above the weekly opening price. Now, large shifts in price that originate from the macro monthly bias will provide the framework of weekly opening price setups. Now, here's a key point. Make sure you remember this because it's not that every week is going to be bullish or bearish. Not every week will move in the macro directional bias. But however, there will be some weeks that move violently in agreement with the macro monthly bias. So just like we have retracements on any other time frame, we may be longer term bullish on the macro monthly perspective, and in the weekly we may be enduring some measure of retracement or consolidation. Okay, this chart shows 4 weeks of price action, And I've highlighted or delineated the opening price for every respective week here. And I want you to take a look at the response. That price shows below the opening price while we're bullish. And then while price makes a really nice buying opportunity here in that green shaded area and it really vaults higher, price gets a little too far ahead of itself and needs to retrace. So the next week, so even though we have the weekly opening price and it does trade below it, we have to be mindful that it may be needing to retrace deeper. The following week, after a retracement and slight consolidation, we have another opportunity where price shows a willingness to show buying strength below the opening price of the weekly range. And again, later in the week on Thursday of that particular week, we see another opportunity after taking out the equal lows that were formed on Monday and Tuesday of this particular week. So there was two opportunities to buy. Monday and Tuesday offered profitability, but then on Thursday it had a deep retracement, retracing down below the Monday and Tuesday's low. But if you look at the previous week, the Wednesday, this low here to this high here, this is an optimal trade entry long, and it's nice how it just overlaps with a run on sell stops below equal lows. And we see a subsequent explosive move to the upside. And in the following week, on Monday of that week, we see that it does create a very nice buying opportunity, and an explosive price movement ensues on Monday trading into Tuesday. Then during Wednesday and Thursday, there's a retracement, and in New York of Thursday has an explosive price move again. And that's when we see it trade up into that long-term weekly high. Okay, moving right along. To complete this teaching, we're going to be referring to now the opening price on the daily. So again, price action is fractal, and what we would see on other time frames can be seen on the daily as well. But the daily chart provides us a short-term institutional bias. So in other words, what the large institutions, insurance companies, and banks, what they're looking at relative to the daily time frame, that's going to be their short-term. Now, we look at a daily chart from an analyst standpoint because as day traders and scalpers, the daily is like referred to as a higher time frame. For institutional-minded traders, the daily is just like that's their executable time frame. That's where they're doing most of their work. The orders are based around that time frame, and that's why it's important to know previous day's highs and lows, weekly highs and lows, intra-week highs and lows, and knowing what the liquidity reference points are around those specific levels. That's going to help you in your development as a technical analyst. But if we're bullish relative to the daily time frame, we are looking to be buying at or below the daily opening price. And if we're bearish on the daily, we're going to be focusing on selling short at or above the daily opening price. Now, the market will gyrate higher and lower relative to the monthly and or weekly perspectives, as we mentioned in the previous slides. The highest probabilities in trading the daily chart is when both the monthly and weekly support the trade idea that you would be using or hunting on the daily. Focusing on the elements of time and price will greatly assist you in analysis and overall development as a technical analyst. If we look at this representation of a daily range here, notice I'm only highlighting one specific day. The teaching that I just gave you here is not to promote the idea that if the monthly is bullish, every week's going to be bullish below the opening, and or every day is going to be bullish below the daily opening. Equally so, when the weekly is bullish, it does not translate into every day below the opening price is bullish. There's going to be times when you have to blend some analysis concepts to arrive at the highest probability setups. Even day trading is not everyday trading. I've said this so many times over the last 10 plus years teaching just Forex alone, and I want to ingrain that in your mind that even though we have tools, and I've shown this in the last 2 months online, every single day finding a setup, I do that to show you what's available in terms of opportunity and understanding. I'm in no way, shape, or form trying to promote the idea that you can find a setup yourself every single trading day. I've been doing this for 25 plus years, and it takes a lot of effort and experience to get to that level. And I'm sometimes wrong too, but many of my new students will see that and they'll say, well, I'm going to do the same thing. And I'm not trying to promote that idea. This teaching was to highlight the importance of going from a higher time frame down to a lower time frame using a similar concept that overlaps and dovetails very nicely. But I want you to go through your charts and study when there are really good opportunities, like this example here for the daily, buying below the opening price. Where does that sit in relationship to what the weekly range and the monthly range and their respective opening prices? Because if you study that, you will figure out where the highest probability setups are. Doesn't mean that you're getting the entry points. It just means that you're highlighting the proper stage when these explosive price moves that move directionally biased happen.
All right, let's take a look at how we can use the economic calendar to find setups and or opportunities to practice in. We're looking at the economic calendar for October 5th, 2020, and I want to take your attention to 11 p.m. and the time is set to Eastern time. Okay, so all of my students have their chart set to this time setting. So at 11:30 p.m. Monday, October 5th, RBA rate statement and cash rate was scheduled to be released for the Australian dollar at 11:30 p.m. Eastern time. I don't care what the actual is. I don't care what the forecast is. I don't care what the previous is. I'm not concerned about that. I'm looking at the red indication here that's a high impact market driver. So regardless of the information or the data that's released, it can have a lot of impact and cause displacement in price, and that's what we're looking for. So let's go over to the charts and take a look at the Australian dollar. So I have the chart set to October 5th. This is a 5-minute chart just to illustrate along the lines what I've taught already on this YouTube channel, but I'm also going to teach you how to blend two patterns together within a market setup. You can see the market has been trading sideways in a consolidation, leaving relative equal highs along the way. And at 11:30, which is 23:30 here on this setting, you can see here, the time is set to New York time. So if you have your chart set on TradingView with that time frame, everything will always match relative to my lectures. At 23:30, that's 11:30 p.m. New York time or Eastern time, and this is the run above all of these relative equal highs. We're not trying to forecast a move. We're waiting to see, does it run above that and will it stay above it? Well, it doesn't. It goes above it and rejects and breaks down. Your eye should be trained right to here, because this high, this low, and the higher high, that's a pattern that I teach on this YouTube channel, which is my ICT bearish breaker. The idea is that this liquidity that we're resting above here would be in the form of buy stops. And we call it buy side liquidity because running above that does two things. It takes traders that are short out by running their stops, so it breaks their position. It also puts traders on the long side on a breakout should they have pending orders resting above here. You'd be surprised how many people trade like this. It breaks above it, trips those traders long, and their stop loss would be where? Below here or below here, relative to whatever their account size and equity risk management would outline. What we're looking for is the narrative. It runs above it and then it breaks down. Fine. If it goes below this low here and it trades back up to this low, now notice what I'm teaching you here. I'm not teaching you support and resistance, because if that's the case, why not just use this low or these lows or this low or these lows here? Why aren't we referring to any of those? It's the narrative behind the specific level that's being referred to. That's what makes this level, as I teach it, as an ICT bearish breaker. If this low is taken out, which it is taken out here, and trades back up to it during a specific time of day. What's the specific time of day? Well, I've been teaching 8:30 to 11 o'clock in the morning Eastern time. You can find setups. You can find optimal trade entries there, and you can also blend a breaker pattern with an optimal trade entry. So I'm going to add some annotations real quick. So here's the breaker, the buy side liquidity that gets purged at the rate announcement at 11:30 p.m. Eastern time. It runs this, and then we wait. What are we waiting for? New York session. New York session trades back up into the breaker, and we can have a short on two things. The fact that we traded back up to the breaker, which is this low, and an optimal trade entry. Using this high here. Now, why this high? It's not cherry picked. That's the London kill zone session high. So we're going to take that fib, and all we're doing is getting a measurement of overbought, oversold. It's not the fib that's causing the magic here. It's not. I'm not trying to sell the idea that the market's working off of just the fib. It's the narrative. The narrative is all of this. It runs, gets everybody offset, and then breaks down. All through London. You don't need to be up trading London. You can wait till New York session. And then with the 79% retracement level, carry that over in time. Starting right here at the beginning of starting exactly at 8:30, which is our New York session window. It's not the New York kill zone. It's just the 8:30 beginning where the news embargo lifts at 8:30. And all the way till 11 o'clock. Already you should be able to see the optimal trade entry that overlaps with the breaker within the time window, 11 o'clock. You have up to 11 o'clock to take the trade. So we have an overlap of the breaker and optimal trade entry, the range from here to here. We're just extending that on time. All of this is just waiting for the New York session. Then the volume that comes in, dog piles in on this optimal trade entry. And we're going to scrunch this up. And we have an overlap of 70, 9, 9, and 9 pipettes. See that right there with the standard deviation of -5. And we have an old level of equal lows, as I teach again on this YouTube channel. So there's sell side liquidity on here. So bank traders, let me take this off. Bank traders can go short with this run up here. You don't have to be in the that move. Wait for this low to break. Once it trades back up into it during the New York session, then you can target this level down here. We have an overlap with the fib for a projected low, and those equal lows that align, and the market sells off and sweeps those relative equal lows and hits our target on the fib. So you have a blending of two of my concepts together within a narrative using the economic calendar to frame it. So we're not trying to predict this break in continuation. All we're doing is saying, okay, what did they do overnight? They ran liquidity out here and rejected it. We can get short in here in London if we want to, but you don't have to. You wait until the New York session. Use the volume that's used in this time of day with the breaker. So now you have this low, projected in time, it operates on it in the London session. At the end of London open, going into Asia's close, then we have the 8:30 in the morning, beginning our time window that I've been teaching here on YouTube. Wait, there. Right at the high, it starts it there, and then one more time, hits it there. But it's inside of the optimal trade entry. In other words, this level to this level to this level. 79, 70.5, 62. All of this area here is optimal trade entry relative to the London session high. And the low formed here ahead of what we teach is the New York open kill zone. But this is just the 8:30 to 11 o'clock window of opportunity where you can take trades. And this is an example of how you can blend two patterns with time of day targeting, and it does a pretty good job of doing a run to that level, and this is where we're at currently. So not bad. You can look for this type of setup when there's an economic calendar event that's a medium impact or high impact, and if it's set to release during the London session or if it's set to release during Asia, that time frame, okay, just sets the narrative, and then just use the New York 8:30 to 11 o'clock and frame it with an optimal trade entry and a breaker, and you have a dandy of an opportunity that repeats a couple times a month. All right, folks, welcome back. This is an example of using the ICT breaker and optimal trade entry in a bullish scenario. I'll give you a chance to take a look at the price action, see if you can find a bullish breaker and an optimal trade entry. When you're ready, unpause the video. Okay, so we're looking at the 9th of October, and you have a low, high, and low. Now, it doesn't look so obvious here on a 15-minute time frame, but we're going to drop down to a 5-minute chart, and you can see the breaker there, and here's the optimal trade entry. So I'll add the annotations: bullish breaker, bullish optimal trade entry into the London open kill zone. So this is the time of day we'd like to see price create a higher low, and if the market is bullish, and I'll zoom out and I'll show you why it was bullish. If you've been following anything on this YouTube channel, you'll see very quickly what made this pair bullish at this time, and it has to do with these levels here, but we'll zoom out in a moment. But I'm going to add the fib so you can see the optimal trade entry. All right, so we have the low to the high, 62% retracement level, 79% retracement level. Extend that in time. There's your optimal trade entry with the overlap of the time of day, London open. And we have a projected high at 0.72431, and it's above this level here, which I'll show you again when we zoom out. And the high on this price swing comes in at 724.3 and 2. So really close. It went one pip beyond, and then has since traded lower. So I want to zoom out. If you recall the previous video I did when we were talking about Australian dollar, I mentioned these equal lows here. Price created that run there, and it left these relative equal highs. So buy side liquidity will be resting above that. Also, if you keep going to the left, there's equal highs over here. So that's what the other level is. I'll let you see it so it's a little clearer. So go forward, and the price creates that optimal trade entry with bullish breaker projected up to here, and take that off, and we're going to drop down to a 5-minute chart. All right, so here's that low to high and low. So you're going to use the up close candle prior to the swing lower, creating a lower low on this price structure. That is a run on the sell side liquidity. If price goes above it, trades back down to it. This can act as bullishness, but then we have an optimal trade entry, which is the low to high, trades down into it with the kill zone. There's where your trade is. And then it runs to that 72.43.2. And there's that price run. All up to there. Okay, so there's the structure, and it's Australian dollar running to the buy side liquidity, and then up here as well. Time of day entry, low of day, expansion with bullishness, attacking the draw on liquidity, which is the buy side liquidity, after it ran the equal lows down here. Okay, so you can see both patterns. The optimal trade entry and bearish breaker that led to this run here, then set up a new price run to the buy side liquidity here with a bullish optimal trade entry and a bullish breaker. So combining two patterns to get precision elements reaching for liquidity pools above relative equal highs.